Okay, we can begin.
Thank you, sir. Good afternoon, everyone. Welcome to this post-policy press conference, first for the financial year 2026-27. We have with us Governor, Reserve Bank of India, Shri Sanjay Malhotra, along with Deputy Governors, Shri T. Ravi Shankar, Shri Swaminathan J, and Dr. Poonam Gupta. We also have with us Executive Directors, Shri R.L.K. Rao and Shri R. Kesavan, along with Dr. Ajit Ratnakar Joshi, Shri Sanjay Kumar Hansta, and Shri Indranil Bhattacharya. I also welcome my other colleagues from the Reserve Bank. Before we begin, we have a few housekeeping announcements. So there are totally 27 participants from the media, and I'll request the media persons to please stick to one question so that everyone gets a chance. I also request everyone to switch on the mic while speaking so that those watching the live telecast are able to hear clearly. And once you have finished speaking, please switch off the mic. Sir, with your permission, I will now call out the names. Thank you, sir. I will request Ms. Lata Venkatesh from CNBC TV 18 to please ask the first question. Lata, please.
Thank you, Mr. Bridgeraj and Governor. So what looked like the structural shift in this policy is that you all have started giving us core inflation number. So a couple of questions attached to that. Core is non-food, non-fuel. So if you are giving us that number, are you indicating that even if inflation headline goes up, but core doesn't, because that could be because of a change in fuel, you will not be moved? Are you trying to give us a message? And in that case, can you also give us the quarterly core breakup at some point in time, maybe from next time? The more important part is, if you look at your second half, while the full year average is 4.4, even then 1 percentage point above last year, the second half average core goes nearly to 5%. So should the market be prepared for a rate hike in the second half? As well, a word on liquidity, will be triple R return.
So first of all, let me compliment you to be, to have been, very nimble in your question. You have noted the change that we have made in this policy statement. I'm very happy, that you have noted that. This has been a request which has been there from the market participants, and so we thought that this was while this has always been a factor. So in that sense, I would not say it is a shift. It's not a shift, in terms of monetary policy decision making, but it's only we thought that this was the right time to do it because we did, the 5-yearly review. So there was a second 5-yearly review, which was completed, and so we thought that this is the time, if we have to do something about it and and give our projections on core, which we have been doing internally, and so that's why these numbers have been given. Monetary policy is not preset course of action. As I have stated even earlier, even in the last statement, I think I made a mention of this, and even otherwise, that it's not, while for us it's the headline which is the target, and we have to ensure that it's headline that remains at target and within the band. That's the goal. That's the primary goal for us. But at the same time, the various components of inflation and where they are emanating from are also very important. And so that has been the consistent policy of the Monetary Policy Committee and of the RBI, and we'll continue to look into all components and then take a call as to how we need to respond to the various components, while keeping in mind that the ultimate target is headline inflation and it's not anything else.
That if first of all, there is an adverse scenario.
So as I said,
inflation you have increased by 50 basis, growth you have brought down less. So it can be interpreted
so
as.
So that's why I said it's not a preset course of action. It's for the Monetary Policy Committee to decide, to take a call. These are the factors, which go into it, how, they are going to play out over a period of time. We will take a call. Things are evolving, so drastically, and so frequently every day, you yourself mentioned, 5:30 a.m., we got a pleasant news, maybe not a complete surprise, but we got some pleasant news. And so we have to, be prepared. And so we will not be, in a position to say what the MPC is going to do in the next meeting.
Thank you, sir. We'll take some more questions from our left side before we come to this side. So for the next question, I'll request Shri Manojit Saha from Business Standard. Manojit, please.
Thank you. Thank you. 1 year ahead, inflation forecast is 4.7%. We have given it here. So the real rate is just 50 basis point, while the neutral rate is seen around 1.5, 150 basis point, 120. So are you falling beyond below the neutral rate? Number two, if you can also throw some light on the recent RBI steps to curb the rupee depreciation, the NOP cap, or banning banks offering contracts to clients. Are you satisfied with the rupee's behavior in the last few days? And now the scenario has changed completely. Is there there's a case to withdraw those limits and caps?
A lot of questions.
Two questions.
Two questions. So your second question first, which is, on the recent regulatory measures that we took with regard to the foreign exchange markets. You are all aware, and you may not have witnessed, but we did notice that in the last few weeks of last month, March, there was heightened volatility in the forex markets. We saw that positions were being built up, leading to arbitrage positions between the non-deliverable forward markets and the deliverable markets. In normal times, these linkages are important for an efficient price discovery. And that's why it has been our endeavor to widen and broaden, and make more liquid these markets. But when there is excessive volatility, when there is excessive building up of positions, this is only, increasing volatility and perhaps not helping in efficient price discovery. Such kind of measures are taken. Whether, and these are reactions to the specific market movements. These are not, in any sense, they are not signaling any structural change. We stand committed long term, we stand committed to the development, broadening and deepening of these markets, to the internationalization of the rupee. And so obviously, these are not measures which are going there forever. As and when, we see that, and you have seen, so much of fluctuation. You can yourself see, how, the rupee has been so volatile. So it's basically, arising out of that. With respect to your first question on the neutral rate, while, first of all, we do not have, very precise numbers on the neutral rate, but there have been occasions when the real rate, because, first of all, you don't have a neutral rate, so what is the neutral rate, but so it's difficult to calculate, what the actual rate, should be. But real rates as of now are still high as of now. Looking ahead, as I said, there is so much of uncertainty to be acting on those today. And especially when the MPC noted, that when there is so much of uncertainty, number one, and moreover, it's coming from the supply side. Having noted that, that's why the MPC thought that this is a time to pause, wait for more data, and then take a call. Real rates today are still about 2% or so. They are not low. Going forward, how it happens, so much of uncertainty. We need to wait and watch.
Thank you, sir. I will now request Anup Roy from Bloomberg to ask his question. Anup, please.
Thank you, sir. Sir, thank you for giving an elaborate answer on this rupee thing. So going back to your date call, I mean, the guidance in February policy that rates will remain low for longer 9 to 12 months, barring any shock. The shock has come, but today we have some clarity also. So would you give the comfort that remain low if the shock is received?
I mean, see, we are in a neutral state. Possibility either ways, anyways, cannot be ruled out. So it is quite possible that these low rates continue for a long time. As I mentioned, structurally, Indian economy is very strong, very resilient, very robust. Despite shocks, we are projecting 6.9%. Despite such a big shock, 6.9% real GDP growth. When you look across, I mean, independent of what other economies are growing, but if you look at relative to them, even better. So structurally, long-term macroeconomic fundamentals, because of various measures which the government has taken, which the RBI has taken, which various institutions have taken, remain to be very